Hey traders, Ethan Roberts here from Mastering TQQQ Trading. Have you ever thought about selling puts? Well, today I'm going to show you how I sell TQQQ puts that return about 75% annually and with a 90% probability of not being assigned. So stay tuned. Alright, so let me get right into this and tell you how exactly I do this. First of all, let me introduce myself. I'm Ethan Roberts, financial writer and a longtime investor. And I am the creator of the Mastering TQQQ Trading course, the Mastering TQQQ Trading Daily Newsletter, the same name on X.com, and the administrator of the largest TQQQ group on Facebook, the Trading TQQQ group. All right, before we start, I'm going to make some assumptions here. I'm going to assume that you already know what a put option is, so you don't have to listen of 2 minutes of me rattling on about what a put option is. I'm also going to say that you already know that TQQQ is an exchange-traded fund that has a daily return of 3 times. However, the QQQ exchange-traded fund performs. So, for example, QQQ is up 1%, TQQQ is up 3%, and the opposite of that, if QQQ drops by 1%, TQQQ will go down 3%. So it's a highly volatile fund, but it's great for trading because of that. I'm also going to assume that you have a minimum of 100 times whatever price put you decide to sell. So for example, if you decide to sell a $44 put, you must have 100 times 44 or $4,400 in your account to secure that put. And remember that each put contract is worth 100 shares of TQQQ. All right, when we talk about selling TQQQ puts, I want to remind you, do not buy puts. That is a losing game. Most people who buy puts do lose. Why? Because decay works against them. And if your asset is not going up to the strike price that you are choosing, it's probably going to dissolve into zero before you get a chance to reach your goal. So what we're doing is we're selling puts, and this is exactly what I do. We are acting, well, if you want to say we're like Vegas or the casino, you could say that, but I prefer to say it's kind of like being an insurance company. We're selling insurance. Every blue moon there'll be a disaster, but most of the time there's going to be sunny, clear days, and we're not going to have to pay out. In fact, we're going to be receiving money. By selling puts, you receive income, and you dictate what price you'd be willing to buy TQQQ. When we sell a put, we want the premium amount to decline. Each penny that it declines gives us $1 more. Now, as an example, suppose that TQQQ sells for $50, and I'm talking about the post-split price because, as you know, this past week, it did split 2 for 1. Well, you might feel like that's just too much money. Maybe the value is less. You just don't have enough money to buy 100 or 200 or 1,000 shares, whatever it is, at $50. So selling a put enables you to choose a reduced strike price. In other words, the price you are willing to pay. And by doing so, you're also letting the market come to you, which is a very smart way to trade. Selling a put enables you to choose the day you're willing to purchase TQQQ at that reduced discount price and how much money you want to receive for waiting. All right, now, are you a good bargain shopper? Let me ask you something. How many times have you bought something like a TV or a phone or maybe just a box of cookies because it was 10% or maybe more off the regular price, right? When it comes to stocks, when stocks go down, most people become afraid to buy. They don't see them as being on sale, but it's really a terrific time to get into the market. Well, we can make our own discount to get into the market. Say that TQQQ is at $50, 10% off that would be $45. We can certainly set it up for us to buy at $45. And let's say it's at $45, we could set it up for us to buy at $40.50, which would be 10% off that. But wait, there's more. Suppose you had to wait a week to buy that TV, but for being such a patient and good customer, the store would reward you by paying you a fee. Have you ever heard of such a thing? Well, I haven't. But that's what selling a put on TQQQ will do for you. My brokerage right now is telling me that if I want to buy shares of TQQQ, I have to pay $47.48. That was the closing price as of Friday, November 22nd, 2025. But maybe I don't like that price. And if I'm willing to wait a week, including the Thanksgiving holiday this week because the market's closed, I can actually try to buy TQQQ for $44 a share. And by waiting, my brokerage is actually going to pay me somewhere between 63 cents to 82 cents per share. Usually I get in about the midpoint or 72 cents per share. Well, there must be a catch, right? Yeah, there's a small catch. If by chance at the close of the market next Friday, TQQQ is priced below $44, I still have to pay $44 to buy that stock. In reality, since they'll still pay me 72 cents per share, even if I pay $44, my break even on this deal is going to be $44 minus 72 cents or $43.28 per share. And that's certainly a lot better than the 47 and change where it is now. But here's the best part. If TQQQ finishes above $44 1 week from now, not only do I get to keep that 72 cents per share, but I have no obligation to buy the shares, whatever price they may be. Now, if I decide I want to, I certainly could, but as long as it's above $44, I have no obligation to buy them. Furthermore, if I change my mind about selling that put at $44 at any time during the week, I can simply close out of the deal. If the 72 cent premium has fallen in price, I keep the difference between the original amount and whatever the current price is when I close it out. For example, let's say the put is at 50 cents. Since my original was 72 cents, I close it out, I keep 22 cents per share. All right, now, like everything else when it comes to stocks, can you lose money? Yes, there is a way that you can lose money. If the price of the option is higher than the original 72 cents when I get out, I will have a loss of whatever the current price is minus that original price. So for example, if the put becomes $1, since my original price was 72 cents, I will lose 28 cents per share. Now, how does that happen? It happens because the value of the asset declines, and as it declines, the put goes up in price. However, there's an alternative. If I don't like how close TQQQ is getting to my strike price of $44, I can always roll the option out. I do this either by extending the time frame by another week or more, or I can lower the price from $44 to say $43 or less, okay, or I can do both. When I roll out to a longer time frame, I probably will lose money on the first put option, but I will make much more on my second week option because it's a longer time period. If I roll out to a lower strike price, I'll lose some of the premium that I have, but I'm no longer obligated to buy the shares at $44. So I'll either save money on the purchase if I'm forced to buy, or I won't have to buy the shares at all. Now, what is the probability of having to buy the shares? Well, if you want to buy the shares at the strike price, you're not going to care about the probability of being assigned. In fact, you're going to be rooting for the price to come down to your strike price. I know you don't want it to go much below that, but you'd be happy at like $43.95, right? Well, if you just want the premium income and you don't want to have to buy the shares, then what you really would like to know is the probability of being assigned versus not being assigned before you choose a strike price and a term. Well, enter the probability calculator, which most brokerage houses have on their trading platforms. This is the one that I use to the right here. With TQQQ at $47.48 near the close this past Friday, the probability of it finishing above $44 1 week later on November 28th was 90%, 90.28% above and only 9.72% below. So this would fit my criteria. What I look for is a strike price over 1 week that will give me a 90% probability of not being assigned the shares because it's going to finish above the strike price, so that I can continue selling puts without having to buy the shares. Now, if I did not roll out or roll down and I am assigned the shares, there's a couple of things I can do. I can sell the shares. Maybe there'll be a small loss, or maybe there'll be a profit. With the 72 cents that I made, I might still eke out a little bit of a profit. But if it's a large loss, well, what can I do? I can take the loss, figuring that it's not going to happen that often, so it's just a cost of doing business. Or I can keep the shares, sell a covered call against them, and get more income or a hedge against further loss. Or I can hold the shares and sell them if and when they come back above my $44 strike price, or maybe even above the $43.28, since that was my break-even point with the put premium that I gained. Well, with a 90% probability rate, there's only 1 out of 10 times that you're going to get assigned, and even less if you decide to roll it out, roll it down, or if you happen to just close it out in advance. Even when you do get assigned, you still keep the premium. Remember that. You always get to keep the premium if you keep it through to expiration. And your winners at 90% will largely outnumber your losses. There will be some weeks when TQQQ will go up a lot on 1 or more days. Maybe that'll happen on a Monday and a Tuesday. And when that happens, that drastically reduces the put premium. As you near the end of that week, and especially when decay starts to take over, your put option may go all the way down to 10 cents or even less. It could be in single digits. Rather than waiting until expiration, you can close it out early just by the command buy to close on your trading platform. And you can simply sell another put option for the following week and thereby get more premium by doing so than the couple of pennies you're going to lose by getting out early. Notice that the weekly return with the $44 strike was 72 cents. Each contract of 100 shares will give you $72 if you decide to carry it to expiration. Now, if we should divide $72 by 4,400, that's 1.6%. All right, I therefore made a 1.6% gain in 1 week. Well, you might say, well, that's no big deal, right? But what if I do this every single week? I make it a habit, and I do this every single week for 52 weeks. That comes to 83.2% annually. Okay, in reality, maybe I receive a loss 5 to 10% of the time. So basically, when you subtract that from the 83%, that's how I make about 75% return on investment annually by the selling of these weekly puts. And guess what? You can do it too. Now, I want to tell you about some huge Black Friday discounts that I'm going to be offering starting today, and I will put the link down below, and I would like you to check them out. This is a special for my YouTube fans. First, my daily Mastering TQQQ trading newsletter. Plus, when you subscribe, you get a free access to my private Discord group that meets a couple of times a month. Or you can sign up just for the Discord group by itself. Or you can sign up for my 4-week monster course, Mastering TQQQ Trading, which starts January 3rd. You know, it's a 2-hour class, 4 Wednesday nights in a row, 8 hours total, and it's just chock full of all kinds of information about trading, strategies that you can use, and also options just like what I've talked about here on this video. So please take a look, and I've got some great discounts on there, 30 and 40%. I think you'll really be happy if you try it out. There's also a way that you can take a look at the outline on the course and a complimentary copy of the newsletter so you can see everything that's in there. Well, at this time, I'd like to wish you all a happy Thanksgiving in the week ahead, and I would like to wish you the very best in trading. I hope you'll try selling the puts as I've described them today and do just as I'm doing, able to make 75% annually. Until then, this is Ethan Roberts saying so long, have a great day, and I'll see you next time.